As I film this, it is Monday, April 3rd, which is the day of the Men's Basketball Championship. A few weeks ago, I started what I call Dividend Madness, which is where I started with the 64 Dividend Aristocrats, which are stocks that have at least 25 or more years of dividend growth, and then I ranked those by market cap. Here is how the bracket currently stands. So we'll take a look at each one of these matchups in red.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
And this time I wanted to mix it up a little bit. Last time we looked specifically at metrics that had to do with having a competitive advantage, businesses that were generally pretty efficient at converting their investments into profits via high return on capital employed, which, by the way, is very similar to return on invested capital, which many of you know is one of my favorite financial metrics. But I had a suggestion from Bashar Baroudi, sorry if I mispronounced your name, which I thought was really good. He suggested add valuation metrics, and then he gave a few that he would request. I didn't actually use these specifically because free cash flow tends to be very lumpy and not a terribly effective valuation metric on its own, but I do think it would be very useful to look at that and maybe a bit of a modification. What I did was take 3 variations of the price to earnings ratio, which I think many of you are probably familiar with. So that's the way a lot of people think about valuation, is just simply, does it have a high or low price to earnings ratio? In fact, a lot of different value funds will consider price to earnings or price to book or price to sales, or usually a combination of all 3 variables in determining value. But in the spirit of coming up with some new ideas that could potentially help you on your investment journey, which is what this is all about, I'm not actually trying to give you specific stock picks or stock picking advice. This is all kind of a fun way to illustrate some valuation concepts, which I hope you will be able to actually use in your investment life. So let's kick it off with our first matchup, and I'll explain some of those metrics. So we have here ExxonMobil on the left, and on the right, we have Sherwin-Williams. We have price to earnings ratio is the top chart. And all this does is simply take the price per share of the stock and divide it by the earnings per share. All else being equal, you prefer a low price to earnings ratio to a higher one. So in this case, the clear winner is ExxonMobil. It has a PE ratio of 8.3 compared with Sherwin-Williams, which has a PE of 29.1. However, as I've argued before, and will continue to argue until probably I lose my marbles, price to earnings ratio alone, or any valuation ratio alone, is not enough to come up with what you think the fair value of a business is. The fair value of a business today depends 100% on the future, not at all on the past. So a business that has a price to earnings ratio of 8, if they're going to lose money in the future, the value of that business should probably be less than 8 times earnings. Conversely, a business with a 29 times price to earnings ratio, but they're growing at, say, 30% per year, that should be worth more than 29 times. So price to earnings alone is not nearly enough information. To help with putting price to earnings ratio in the context of future growth rates, Peter Lynch famously used the concept of what he called the PEG ratio, which is to basically take the price to earnings ratio and divide that by the expected long-term growth rate of those earnings. So generally, a PEG ratio of less than 1 would be considered an exceptionally good buy. A PEG ratio of less than 2 would be considered a decent buy. So in this case, you see that the PEG ratio for ExxonMobil is 0.69, which is exceptionally good. Conversely, the PEG ratio for Sherwin-Williams is 4.7. So far we have a lower price to earnings ratio and a lower PEG ratio for ExxonMobil. And the next metric I used is the price, only this time we're using the 5-year average earnings as opposed to just 1 year. And the reason we do that, this is actually something that Ben Graham and Warren Buffett advocate for, which is to consider one metric over the span of an entire business cycle. So in the case of ExxonMobil, look up here at PE ratio, you can see there was actually a gap where there's no PE ratio for about a year, and that was because they had negative earnings. However, the actual earnings power of ExxonMobil was obviously not negative. They just had a temporarily bad period. You could also make the argument that right now they're having an absolutely really good period that may not be easily replicated. So by using the average earnings, we're getting a better picture of what they're most likely able to earn over a longer time period. So by this metric, we see that again, Exxon has the lower price to 5-year average earnings, but it's still a victory for ExxonMobil. They're trading at 23.4 compared with 35.7 for Sherwin-Williams. But here's where things get pretty interesting. So what I did in these bottom 4, and what I would probably prefer of these valuation metrics, is I took the price at the median of each one of those historical ratios. So for example, the median 3-year price to earnings ratio for ExxonMobil would consider, okay, what is this stock typically traded at over the last 3 years? And let's assume it were to trade at that exact same PE ratio today, what would the price be? Then I did the exact same thing for the price to sales ratio, the price to book ratio, and then also I did a dividend yield channel. So in other words, what would the price of ExxonMobil be today if it were to trade at the same dividend yield that it has over the last 5 years? So in this case, the price is much higher than this would estimate it should be, meaning that the current dividend yield for ExxonMobil is a lot lower than it has historically been. So if the price to earnings ratio were to increase to make that relationship consistent with the last 5 years, that means the price needs to decrease to $66.29. Instead of just give points based on each one of these metrics, I thought I would just take the median of these. So we're probably going to have a couple that are off for one reason or another. So I think earnings here are a bit crazy since you had that negative period and then also a massive increase. The actual price is 109.66, and this is saying the stock should be 202.63 if it traded at the median 3-year price to earnings ratio. That is the most extreme undervalued of all of these. So I'm going to cross this one out for consideration. And then on the other end of the spectrum, we have the dividend yield channel. In this case is at 66.30. So again, let's cross out the most pessimistic and the most optimistic. And then we're going to take an average of the two middle numbers. So here we have the price to sales and the price to book. If we average those two numbers, it comes out to $95 per share, or about 14% overvalued. And if we do the exact same methodology on the other side, we would cross out the most optimistic estimate, the most pessimistic estimate, which leaves us with the price to book and the price to earnings ratio. If we take the middle of those, it's about 281 compared with the current price at 225. And if that were accurate, this stock, Sherwin-Williams, would be 25% undervalued. So you can see that using these two very different methodologies, we come up with two very different answers. And that is why coming up with a fair valuation for a stock is a very difficult task, one that has historically been rewarded very handsomely. If you look at all the famous value investors, they almost all have outperformed the market by a significant margin. And the reason is that they're able to come up with a better fair value than the rest of their peers, and they're able to stick with their guns over a long period of time, eventually being rewarded for their better analysis. Shameless plug, if you're interested in more information about valuation, you can check out a link to my valuation course in the description down below. This is a pretty tough call. I think you could say this is almost an exact tie, but in this analysis, I'm going to tilt a little bit more towards these market-based multiples. So I'm going to go with Sherwin-Williams as being the better value here. But don't grill me in the comments. I think you could easily make the argument that Exxon is actually the better value, but here I'm going to go with Sherwin-Williams. And the main thing is I think there's a huge variance between what analysts, so this is currently the high-end analyst estimate for long-term earnings growth is 43. The low is -12. So there's a huge amount of uncertainty about whether their earnings will, how much they'll grow, or if they'll even shrink in the future. Obviously, that has a lot to do with oil prices. Whereas Sherwin-Williams, there's a big gap between 0 and, call it 11, but a little more certainty here. And I think the historical multiples would suggest Sherwin should be trading higher than it is now. So we're going to say Sherwin takes this round and moves on to the Sweet 16. This one we've got Caterpillar versus Medtronic. Cat wins the PE ratio with 18 compared with 26.5. Earnings growth is very impressive and consistent for Cat, 14% compared with 5. So that means our PEG ratio at 1 is also much more attractive for Cat compared with Medtronic. The 5-year price to earnings ratio slightly favors Cat, but it's a little more favorable, at least than the PE and the PEG ratio were for Medtronic. But again, Cat takes the win there. We can cross off the optimistic and the pessimistic estimate, which leaves us with an estimated value using these two, called an average of 225, and the stock is currently trading at 228. So it appears that Cat is approximately fairly valued, maybe slightly overvalued. And on the other end, we see that consistently Medtronic appears to be undervalued. It looks like you've got the one outlier here at 90.71, and then the most optimistic at 107. But these really grouped around 105, 106 compared with 80. So again, we have this kind of awkward scenario where one stock is appearing to be a little bit overvalued and the other one appears to be undervalued, even though the multiple-based analysis suggests the other. And I'm going to just talk out of both sides of my mouth. And in this case, I'm going to go with Cat only because I think this growth rate, again, 12 to 16, very tight growth rate, very impressive estimated future growth rate, only trading at 18 times, PEG ratio of 1. And I don't think these necessarily suggest the stock is overpriced. My concern with Medtronic is that it appears to me that you have a decent amount of roll in the estimated growth rates. They're also not terribly attractive. Trading at still 26.5 times. The historical multiples would suggest this is a good value, but I'm just concerned that you've got some kind of fundamental erosion in these. You can see specifically on the price to earnings ratio, the actual fundamental estimate, the blue line, is heading lower. Same slightly for price to sales, same again for book value, and same again for dividends. So it just suggests there may be a bit of a fundamental erosion here, which I don't feel terribly comfortable with. So in this case, I'm going to go with Cat. They are moving on to the Sweet 16. And that last round shows you just how subjective valuation is. It is not a science at all. It really is an art. It's part science. There's tools, which, I or someone else could help you learn how to use, but at the end of the day, the analysis is 100% on you to determine what you are looking for in a particular business. In the next round, we have Stryker versus Nextera, and hopefully one of these is going to be easy. We'll see. Stryker with a PE of 46 compared with 37 for Nextera. So Nextera takes that round. The consistency of earnings actually looks very similar. Maybe you give a slight nod to Nextera for more upside, but this is not going to be much of a factor in this round. PEG ratio, again, favors Nextera at 2.6. The price relative to the EPS 5 also goes to Nextera at 35.7. And then if we look at our multiple-based analysis, we'll cross out the optimistic and pessimistic scenarios, which for Nextera leads us to an estimated fair value of about $85 compared with a current price of $77. So approximately 10% undervalued. And then let's take a look at Stryker. Looks like their optimistic is $299, pessimistic is $247. And then we've got basically a dead tie at $285, which is sort of interesting. So $285 and the stock is trading at $285. So this is basically fairly valued on Stryker. So the clean sweep, finally, an easy one, goes to Nextera. Next round, we have Parker Hannifin going up against Chevron. We have a very similar situation that we saw with Exxon here with Chevron, where PE ratios kind of go dark for a little bit when the earnings were negative. Same thing happens with the PEG ratio. And then we also see this massive disparity, although not quite as much with Chevron compared with Exxon, but you've got somewhere between -9 and 24% earnings. So generally I view this as a negative. I like to see more consistency and certainty. not necessarily wild uncertainty in a particular stock, whereas you see the opposite, Parker Hannifin, very consistent estimates at between 13 and 14 and a half. But again, you've got a 35 PE for Parker Hannifin versus 9, very clear victory for Chevron. The PEG ratio, on the other hand, actually goes to Parker Hannifin. The growth rate that they're estimating comes that price to earnings ratio at 1.2 compared with 1.5. Pretty close, but Parker Hannifin takes the victory there. Price to average earnings, 32 versus 25. So Chevron takes that one. So now let's look at the multiple-based analysis. Again, we're going to cross off the most optimistic, which looks like it's here, and most pessimistic here. Take the average of the remaining, gets us to an estimated fair value of 290 compared with the stock price actually trading at 336. So about 13% valued. Compare that with Chevron, we've got 305 as the obvious outlier, 126 as the outlier on the low end, and then we take an average of 131 and 195 gets us 163, and the stock is trading at 163. So again, we have an easy one. Chevron takes everything except for the PEG ratio and the consistency of earnings. So Chevron moves on to the Sweet 16 to face Nextera. Next round, we have Expeditors versus 3M. Similar price to earnings ratios, but you have 3M at 10. Earnings growth also very similarly bad in both cases. 10, and you got some negatives here for Expeditors and very negative 14 for estimates. Also ugly for 3M. It's kind of like the battle of the 16 seeds. You know, it's the neither one looks terribly great, but you got to pick one. So PEG ratio, both of them look atrocious, but Expeditors slightly better at 3.46. By the way, these are calculated by portfolio 123, which you can see the little logo there. I like to use the software just for a quick way to see these charts. The price relative to the historical 5-year 3M takes it at 11. And then using the historical multiples, you can see that both of them are going to show significantly undervalued. The predicted values are consistently higher than the current price. Let's start with Expeditors. Extreme high is off, extreme low is off. So we're average 122 and 165. Gets us to about 144 relative to a stock price of 110. So about 30% undervalued. Again, I think the concern is that, well, this fundamental value is eroding, so is it really 30% undervalued? I think that's probably optimistic, but let's just roll with it. 3M, very similar. We're going to have a massive undervalued situation. The most pessimistic at 165, most optimistic 197. So we're basically at, call it 179 fair value, and 104 is the current price, 105. So this would be 70% undervalued. Again, I think 3M is in a permanent state of decline. I do not like this stock in the slightest, but somehow it has managed to make it through to the Sweet 16 by facing some poor competition. Hopefully 3M gets eliminated next round. I think it probably will, because we have two juggernauts next, WST and ADP. While the last round was a battle of the 16s, this one's a battle of the Titans. We've got West at a 45 PE, which is pretty rich, versus ADP at a 29. ADP takes that one. Growth rate, obviously ADP is better, and the PEG ratio is wildly better for ADP at a 1.8 versus WST at a 12, which is the highest we've seen so far. Price to EPS 5, again, huge advantage for ADP. If we look at the ratio-based analysis, we see something very interesting with ADP, which is, to me, one of the weaknesses of price to book. And that is, if a business is buying back a lot of stock, the book value will show as lower than it actually is. So the price to book is going to be high, even negative in some cases. So this is one I think you would normally just ignore on a case like this with ADP, where it's buying back a lot of stock. But in this case, we'll ignore it because it is the most pessimistic analysis, saying it's worth 115. Price is currently 222. So kick that one out. We'll also kick the optimistic out, and that looks like it's going to leave us at an average fair value, basically right where it is. It's approximately fairly valued for ADP. With West, we've got some wildly different analysis. 208 versus 438. We'll cross those out. Saying the estimated fair value based on the remaining is 408 versus 346. So about 18% undervalued compared with fairly valued. So again, we have mixed results. However, in this case, I think I'm going to give the victory to ADP. And the main gut feel here is that the trajectory of the fundamental value, so the blue estimated lines, is consistently higher with ADP on earnings, also on price to sales, and also on dividends. Book value is different, but I think that's because they're buying back a lot of stocks. This is kind of a throwaway in my mind. Whereas you see here on WST, they actually have some fundamental value estimate erosion. So that's falling, that's flat. Price to book is increasing, and so is dividends, but that combined with the super high peg and these very low growth numbers that are also turning lower, I think the safer bet is to go with ADP. So we're moving on ADP. Another good matchup, we have Canadian National versus Lindy. PE 20 versus 43, easy win for CNI. The growth rates are better. So the peg ratio comes in a little better for Lindy at 2.8. versus 3.5 for CNI. The price to 5-year average, 25, wins it for CNI versus 47. So pretty rich multiples on Lindy for both PE and PE5s. Let's take a look at the market-based analysis. 138 gets crossed off, 118 gets crossed off. We're left with, call it 130 on a price of 118. About 10% undervalued on those metrics. Versus Lindy, we have a high of 405 estimate, low of 273, which leaves us with an estimated fair value of, call it 305. So significantly overvalued here, actual price 355. So we're going to go with Canadian National, I think, as a pretty easy winner here. The last matchup on left, APD versus Cardinal Health. PE slightly goes to Air Products. Growth rates also go to Air Products. And I don't know, I feel like these peg ratios are inconsistent. 186 versus 138. This actually should go to Air Products. Kind of confused why it wouldn't lower PE and higher growth rates. So I don't know what portfolio 123 is using in this case, but let's go with Air Products on that one. This Cardinal Health actually has negative earnings over the last 5 years. So that's not good. Basically makes this completely unreadable. You can see that it doesn't hardly register a value on some of these. This is just extremely volatile. You can see that the fundamental value, the blue line, is just up and down all over the place. And down there on the dividend estimates, not even there on price earnings. So I'm going to give the clear victory here to Air Products. I think all of these are showing undervalued, slightly overvalued. But this definitely takes this round just on consistency alone. And one quick point to make on that, if you have a business that's extremely erratic from year to year to year, it's going to be very difficult to value. I would encourage you just, what I do on those, cross them off. It's on the too hard pile, just throw it off. It's not worth trying to invest in a highly speculative business that's just all over the place. If they cannot consistently produce earnings and consistently grow those earnings over the long term, in my view, it's not a very compelling stock to buy. Next matchup, FactSet versus Cintas. Price to earnings ratio are basically tied. Growth rates also very similar. So we're going to have very similar peg ratios. Again, I think these should basically be exactly the same. Very close matchup. Slight victory to FactSet on the price to 5-year average, 45 versus 50. Both are quite elevated. So this one's really going to come down to the multiple-based approach. We've got 332 pessimistic and price to book at 562 optimistic. So we're going to end up with a fair value of between 455 and 424. So 440 compared with an actual price of 415. So that is a 6% value. And on the other side, we've got 453 and 403 as our middle estimates. Both of those are going to be lower than 463, which is the current market price. So the victory here goes to FactSet. In this round, we have S&P Global versus Chubb. Chubb takes the PE ratio. S&P Global is wild on the estimated growth rate, somewhere between 14 and 42. That's a huge dispersion. PEG ratio, both of them are phenomenal. but Chubb takes the slight victory at 0.8 versus 1. Chubb also takes the PE5 ratio. And then using the multiple-based approach, we get 170 fair value versus a 195 price. So a little overvalued for Chubb. Crazy estimate for book value. S&P Global has very little assets, and they also do a buyback. So we're going to throw that one out. The most optimistic is by far that one. The most pessimistic is 346. So if we take 405 and 352, sounds like the fair value should be about 375 compared with 345. About 9% undervalued compared with 13% overvalued. I don't think there's a big enough difference between these two on some of these other metrics to justify going with Chubb. So I'm going to take S&P Global here. Next, we have Target versus Lowe's. Lowe's wins the price to earnings. Lowe's also wins handedly the estimated growth, which means they absolutely crush it on the PEG ratio. Target gets the win on PE5. On the multiple-based approach, Lowe's looks to be slightly undervalued, 210 versus 200, so 5% undervalued. Target, on the other hand, is about 170 versus 165. So a very slight edge is going to go to Lowe's on that as well. So I think Lowe's sweeps this one except for PE5, and they're going to take this round. Next, we have Colgate versus Pepsi. Pepsi wins on PE. Colgate wins on growth and also on the PEG ratio. Basically even on PE5s. But again, we have very erratic numbers on book value. So let's cross this off. Cross off the optimistic estimate. Gets us $66 versus 75, about 11% overvalued. Pepsi, you can see it's just extremely consistent, both metrics, suggesting about fairly valued. So I think Pepsi is going to take this round. 4 more to go. Next matchup, PG versus Archer Daniels. ADM wins on PE, but negative 5.1 makes the PEG actually negative. Again, I don't know how they're calculating this. This is way off. But anyways, PG is going to take that and that. The PE5, Archer Daniels again takes the win. And if we cross off the extreme dividend estimate and the high-end optimistic estimate, we're ending up with about 145 and the stock's trading at 149. So as you might expect, PG just doesn't really ever get too underpriced relative to what it's worth, about fairly valued. If we look at ADM, we'll cross off the most pessimistic 58. Most optimistic is 117. So using the midpoint of sales and price to book suggests this stock's worth about 80.50 and the price is right at 80. So again, about fairly valued. So in this case, super close. I'm going to go with PG just because I do not like this earnings gap missing and then also this negative estimate for growth. So PG will take this round. Next, we have TROW versus Thomson Reuters. TROW takes it on PE, but again, you have these negative, sometimes significantly negative growth rates, which means the PEG ratio is terrible, whereas on Thomson Reuters, you have a high PE, but also a very high growth rate, which makes the PEG ratio a little bit more attractive. The price relative to average earnings of the last 5 goes to TROW at 12.3. And then just looking at the charts, very obviously, this is going to show as overpriced because every single one of them is less than 130, which is what the current price is. Whereas on the other side, you have the exact opposite. So TROW is easily going to take the valuation round. Last 2 games, we have ITW versus Dover. PE slightly goes to Dover. Much better growth rates. So the PEG ratio is easy for Dover to win. Also has more attractive PE 5. If we throw out the top and the bottom, it looks like we're again using price to sales, historical price to sales ratio, and historical price to book to estimate the fair value at about 159 compared with 152 is the actual price. So slightly undervalued. Whereas on ITW, we're going to come up with very similar numbers again, 252 compared with the actual price at 244. So very slightly undervalued for both. But when you take into consideration all of these metrics, easy victory goes to Dover. And then the final one, we have a matchup between Nucor and McDonald's. This is going to be very interesting because you, again, have a PE ratio that is super low, 5.4 for Nucor, but the earnings for this have just absolutely skyrocketed. Whereas McDonald's trading at 34 seems way overvalued, but as always, there's more to the story. Nucor has an estimated growth rate of -12 versus McDonald's very consistent at 7. So this negative makes this basically irrelevant. You're going to give the victory to McDonald's, even though it's 3.4, not terribly attractive, but better than Nucor, just the uncertainty. PE 5 goes to Nucor, 11.7 versus 35. McDonald's trading at a very large premium. Now when we get to the multiple-based approach, we have a wildly high estimate of fair value using earnings. Again, I think that's because the earnings have spiked a lot, so that makes it appear that it's way undervalued using this technique. So this, cross this off, cross the 83.30 estimate from dividends, gets you to an estimated fair value of about 148, paired with the actual price of 155. So slightly overvalued here. Again, with McDonald's, you actually have a negative book value because it's bought back so much stock. So this is completely crossed off. So we'll take the remaining numbers, cross the low, cross the high, and McDonald's estimated at 264 versus 280 is the current price. So again, slightly overvalued. In this particular case, I think you have very similar pictures, both slightly overvalued stocks on the multiple-based analysis, but again, this negative estimated growth rate on earnings, the potential that these earnings have just spiked temporarily, I think you have to go with McDonald's. So that wraps up our Sweet 16 matchups. There's what I came up with. Let me know in the comment section what you agree with, what you disagree with. Let me know in the comment section if you'd like me to continue this, and if so, if you have any ideas for how I could determine the winners for the next round. I do have something specifically in mind for the final four, which will be a little bit more of an in-depth analysis when it comes to both the subjective side and the more detailed valuation analysis. I'm going to maybe use a little software program that I built just to kind of show you how that works. If you hate this series and just want me to kill it right now, let me know that as well. Quick announcement for those of you who have purchased my valuation course. I am going to answer a couple questions that I received over the last few weeks. I'm going to be making a video about those and posting it for the benefit of everyone. And then also I'm working on building a dividend yield channel model in Excel that you'll be able to use some data from Yahoo Finance to look at the dividend yield channel for any stock that you would like. So I'll be posting that video hopefully this week. Thanks for watching, and I will see you in the next video.